On that note, take a look at the market. We are holding on to that 25,300 level. The broader end of the market is moving largely in tandem with the benchmarks. The bank nifty as well, holding on to that 55,200 level. Breadth solid as of now, almost 3:1. That's the NSE advanced decline ratio. And IT was doing well, taking the lead ahead of the Fed rate decision that looms and of course comes out later today. But on that note, let me bring on board the big market voice that we always get at 9:30 a.m. Sunil Subramaniam, market expert as always. Sunil, lovely chatting with you. And this seems to be a month where it's seasonally a weak month, right? If you look at how we have performed in September, both globally and domestically. But this month to date, we've seen the Nifty regaining traction, 3% kind of up move on a month to date basis. Global markets have been hitting record highs almost every other day. So it doesn't seem to be a month where you say wake me up when September ends. Things are falling into place in terms of the US India trade talks as well. A lot of bonhomie between Trump and PM, who has his birthday today as well. So how are things looking? Do you think September will be a turnaround month where FIIs also come back as we are looking at a Fed rate cut today?
I'm surely hoping so. And so, what I'm reminded of, you've seen Diwali Dulhania?
Who has not seen
Yeah.
that movie? Any movie lover would
Okay.
watch it.
So, what I'm reminded about is Shah Rukh looking at Kajol and saying, Palat, Palat. और पलटेगी तो so exactly the same with Mr. Trump, right? The whole thing has been about anticipating, and he palted. You may say he palat. So I think that's the thing story which has been playing out because rapidly, I think he's probably done 5 tweets which are pro India. After that, India, I've lost India to China and Russia tweet, and then he's come back with so many strong things, including the latest one, wishing, calling up the PM and talking to him. So I think that's what is the read of the market because you asked about September being a weak month, and economy wise, it is going to be a weak month because people are going to be postponing all their purchases till the 22nd because of the GST rate cuts, right? So the numbers for this quarter may not look great, but the markets are saying that I'm aware of this and I'm looking beyond this, right? So how is Diwali going to be doing? How's the monsoon going to be playing out its story? And how are the corporates? Are they, willing to support the government by actually passing on a majority of the rate cuts onto the customer? So I think that positivity has obviously been there with the DIIs, but from an FII perspective, I think it's this change. And I don't know whether I mentioned it, Nandita, in my earlier shows with you, that one of the reasons the FIIs have been weak on India, right? The valuation is, something that's been beaten to death. Everybody is talking about it. But I think there's an important two other factors. One I'll tell right now, one we'll probably discuss when we discuss the Fed rate cut situation. Is that see what the FIs have, if you look at last year, right, April to September last year, markets were rising because FIs were buying. And it was not that in April of last year, India was any cheap. India was at roughly the same or even higher levels of PE ratio, right? Why were the FIs willing to buy then, and why were they not willing to buy now? The difference is that what the tariff has done is affected India's long-term growth prospects. So I'm just saying that, see, we have built enough defense mechanism against the tariff. That's why even S&P in their rating said that India can counter the tariff and still upgraded our rating. Fitch in fact has come and said that we'll probably hit 6.9% this year. So in a sense of the short-term impact of the tariffs, right, apart from those specific textile, leather, those autocoms, those which are directly affected by the tariff, the overall scenario is that India's GDP growth is well on track to remain at the 6.5. But FIs are not buying the 6.5 or 6.7 or 7 of this year and next year. They are buying the growth of India into 7.5, 8, 8.5 over the next 5 years, the decadal growth. Now, for that, right, we need to be exporting to the US. And that's where the tariffs have come and damaged the longer term story of India. And that's why if you see longer term FIIs have been hesitant to put in money and short term FIIs have been booking profits. That's because they've got opportunities in China and other markets which are far more reasonably valued. So where I'm coming from is, so this news that India could be, on the easing front on the tariff. See, the second 25% obviously expect market expects it to go away now because it's all about Russia. And in yesterday's tweet, he says, "Thank you for helping end the Russia-Ukraine war." I don't know what is pipe he's poking. He means that how have we helped him solve the Russia? Neither is the Russia-Ukraine war looking at a solution. But he just retweeted that. So what I'm coming to say is that the second 25% he realized that it didn't work. It brought Putin to Alaska, made them chat. That's it. After which Putin has doubled down and Ukraine has even doubled down. The war has only escalated after that. And that's why in his tweet he is now roped in NATO to say now he wants NATO to help put tariff on China because he alone doesn't have the guts because he imports what? He's got a net trade deficit of $400 billion with China. He can't afford to do that. China holds $800 billion of US government securities. So, and they hold rare earth control. So there's a lot of things that he cannot do individually against China. So he's really roping in NATO to try and do that. But in that message, there's no point of India. So I think that clearly in the trade talks, I see from the Indian point of view in a silent way saying, let's talk about the core 25%. No, the second 25%, there's no justification. And if you want, right, we can always buy oil from you also. It's not as if we'll buy only from Russia. We are buying from a number of countries. Russia is a big one because they give us a discount. Now, if you want, we can buy oil from the US because oil prices are internationally determined. So that could be one of the agreements which I feel could be an early win that India agrees to buy X barrels of oil from US. And then that 25% goes away, the second 25. On the other 25, I would still say that, there's not too much optimism that the red lines would be broken, right? Which is in terms of your agri and dairy access, as well as allowing American companies into that is one of the main things that they want. There may be a tough situation that we might allow, some of the high-end cheeses, for example. Some where media they'll come out. So where I'm coming from is from an FI, wearing my FI hat again once more, is that they now see that we are now compared to a month ago when we were like the dog in the thing, right? Right from Navarro to Scott Bessent to everybody was piling onto India. So now actually the trade aid comes here, talks, Trump talks, which means there is some light. And so once that comes through, it means that the medium term growth story of India comes back into play. We can reasonably hope because remember, US is 30% of world GDP. No country in the world can think of having a super growth rate without being selling to the US because the US is so expensive as a market. All this MAGA, all of those are political things. There's no real way that Americans can buy America manufactured products because the cost in India is $1.50 per hour, in US is 30. So it's 20 times the cost. Now, which American would be willing to pay 20 times what he pays for anything just because of the patriotic MAGA thing? So I think MAGA is just a political gambit. He will do it. He will try and get some business there, some wins he will show, which is all politicals and PR. But bottom line is a country like the US, which is a demand-driven economy, consuming high-end products, needs to have a low-cost manufacturing country supplying to it. Yes, the earlier balance of trade between China and America was tilted heavily in China's favor. That's the reason he had to put the tariffs. Because of the $26, US is at $30 manufacturing cost per hour, China is at $4. So the $26 difference in cost was largely eaten by China, retained by them because US had no choice. That did. Even today, they don't have a choice because India is not ready yet to substitute China. We don't have the skill, we don't have the technology, we don't have the AI, we don't have the those kind of things to compete. But we are a dream for the future. So where I'm coming from is that difference between 30 and 4 out of the $26, China probably took away 20 and made US as one of the biggest borrowers in the world with a unsustainable fiscal deficit and all of that. The new terms of agreement, which if India is to work towards being a substitute for China in America's eyes over a decade, over the next decade, will be a more reasonable share of the savings because there will be more with India. 30 minus 1.5 is $28.5 per hour. That will be a more equitable share, not like the what China did. But it is important for India because whatever we get is plus. Today, 2% of the world exports is our manufacturing, trade goods, export share. So where I'm coming from, just to cut the story short, is that this news is probably the single biggest news which would make a longer term FII think back to investing in India and valuations be damned. Because when you're buying a longer term story, these valuations are 1 year forward PE. When I, as a pension fund, am investing in a 15-year outlook, what do I care about what the 1 year forward PE? I want to calculate my discounted cash flow of a potential stock in India for the next 5, 10, 15 years in a reasonable growth story. So I think that's where I believe that, and yesterday, small thing where I think there was a 300 crore positive FII flow. I hope it's correlated to this. But over the last week itself, I've been seeing that, like in last week, remember, 2 out of the 5 days was positive and one day was just 100 crore negative. So the situation
Yeah, yesterday as
marginally.
well it was positive.
Correct. So I think that to that extent, I see this as a green light. And the more the positive news comes out of these talks, and Mr. Navarro can kindly keep quiet on the side and not add more fuel to the fire right now, I think it will lead to a tilting of the longer term FIS towards India. The shorter term FIS are also going to be tilted. I'll tell you why. Because the depreciation of the rupee is a key factor for hedge funds. And if the tariff situation was not going to get easily solved, India was going to need to aggressively devalue the rupee to counter the tariff. And that was a fear why, one of the reasons why short. I said I'll mention the second reason later, right? Because for them, a fear of rupee being depreciated for help the exporters counter the tariff means that their investments will get eroded due to that capital depreciation on currency. So they were being smart, saying, let's see this situation grow. Now, even they will tend to come back because India won't feel the need to depreciate the rupee so much. And so then comes to the Fed rate cut. Because what happens is that 25 basis points is market is taken for granted. If it's 50, let's talk about it. If it's 50, then
Yeah.
obviously the dollar is going to weaken and the interest rates are going to come down. The pressure on the RBI to cut is going to be there because, but if it's a tariff situation, RBI would have not cut and let it depreciate, right? But because the tariff situation is improving, the RBI will also want to keep a more balanced approach. So the possibility of an RBI rate cut then goes up. So RBI has got to be taking that factor into account. But all early days, but I'm just saying that compared to the pessimism that we had some weeks ago on the FII flows, of course, since August 15th, it's been positive for domestic of the GST cuts. But from an FII perspective, right, the tariffs has been an overhang. There is a lightening of the dark clouds there, and one hopes that they do turn into a silver lining and maybe into good. So, like I said, so that's why September it's been good from that sense from a market perspective, is because I think Mr. Trump's palate, coming back to my starting word, has helped FIIs take the foot off the pedal on selling in India, which itself is a big thing because you see markets will respond very positively because DIY buying is constant. So any delta that
Yeah,
comes through
that's been
from the
there.
FII will take the market quite higher. So I think that yes. So in all, I think I'm optimistic of a good September because of the return of the prodigal FII.
Okay, so return of the prodigal FIIs could be baked in. Of course, because of Trump's palat, let's hope that we see a palat, kaya palat, so to say, from FIIs soonest as well. Because of course, we also have the Fed rate outcome today, and if it's a 50 basis point, as you pointed out, of course, that could be another trigger. But let's talk about themes then, because we've covered quite a lot of ground in your first, in the first, question that really we spoke about. IT, you have been, a contrarian when it comes to IT. You've always been saying that, once FIs come back, IT, which has seen quite a fair bit of underperformance, would start firing up. So, in terms of IT, of course, we've already discussed a few stocks in the past. But post the buyback announcement by Infosys, that was its largest ever, do you expect more companies to come out with buybacks? And from a shareholder perspective, would that really benefit because of the changes in taxation? What are your thoughts on the overall buyback coming back in the IT space?
Sure. Before I address this, just one more point I want to make on the FII flow because it's relevant to IT is that one of the reasons why the FII selling was very high was because of withdrawal by investors from India specific and emerging market ETFs because they were not favoring, they were willing to wanting to put their money in the US market. Especially there was some India specific, you saw massive outflows. Okay. So why I'm saying this is that if the FI rate cut happens, the Fed rate cut happens, sorry, then the risk on will mean a lot more money coming into passives, emerging market passives. And India, as you know, has a 17% share of the MSCI emerging market index. So what I'm saying is that that buying will come in, and IT is a 10-11% weightage in the MSCI index. So you will get a passive amount of money coming in and buying IT. So that's one of the things which is going to drive IT up. Is just the allocation from the passive. So it's not necessarily an active call. It's just an active emerging market call into which IT will benefit. That's one. Right now, to come to the all the questions. Yes, see, the buybacks are not a tax efficient way because of the taxation rules have changed. Okay, and hence, I don't expect a domino effect of the Infosys buyback to lead to buybacks by other IT companies, right? Now, why did Infosys then do the buyback, right? What you got to look at it is that for them, they're sitting on a huge pile of cash. I think about 45,000 crores. Okay, they're using I think about 18,000 crores in the buyback process. So, when I'm coming from is they're trying to shore up the share price rather than do anything else by reducing the stock in the float, right? That's what a buyback achieves, right? That's one. Second is you got to also see because of the taxation how far will be successful because they're going in the open offer route, right? So we'll have to wait and see how that pans out. But the key thing is that why I also don't expect other companies to follow through. One is, of course, it's not a good tax way of giving money back. Rather pay a hefty dividend rather than do a buyback. Number one. Number two is that I think that all the IT companies will need cash to buy good potential mid-sized AI companies. That's the way they will defend. They cannot overnight create an AI culture. You see, the layoffs from TCS, all of that was getting rid of the people who are not fitting in. And they'll probably take freshers who they will train. But if the IT companies have to make a what do you call short circuit into this AI related consulting work, I think that they will have to go and buy some good quality international companies, right? And they'll need cash for that. Now, in case of Infi, they still have 26,000 crores of cash even if the buyback goes to 18,000 crores. So it's not a worry. They have adequate money. But all other IT companies also, it's a question of are they targeting potential acquisitions? Are there discussions happening with investment bankers? How much do they explain the price? So that cash on the balance sheet, right, for them is something which is they would not want to commit it and give it away today. So I don't expect this to really follow through in that context of that. But I continue to retain my bullish view on IT. In fact, the most surprising thing probably is that post August 15, I think the Nifty is up about less than 3%, 2.75%. But the IT index is up 4%, which is something nothing to do with the GST cut, but it's actually beaten the market. And that's because of two, three things. One is, like I said, I think that it was oversold. So more from a technical point of view, I think there was too much bad news being thought about these companies are old word. In fact, when Oracle's stock went up that day, there was a big headline in newspaper saying Oracle is the forward-looking future company. Indian IT companies are backward-looking. There's a lot of negativity around the fact, but these are cash-generating machines who have seen multiple changes in the world order, whether it's the financial crisis, whether it's the dot-com boom, whether it's the YTK, and they have survived and grown. And AI is something they will absorb and they will do. So we should have the confidence, and that's the confidence I carry. I think that they are good quality companies, very low debt on the balance sheet, throwing out cash, who can go and do mergers and acquisitions without needing to have financing to do that. They have cash, and hence they will thrive and grow. Obviously, you don't know which of these companies will do the best acquisition, so you should stay invested in the pack. The second aspect here is that, though of course we talked about tariff concerns easing, but if the tariff situation was continuing, because this rupee weakening, right? The rupee weakening is, if at all positive for anybody, is positive for IT. So obviously that also played a part, and especially when FIIs come in, for them it's a natural hedge because IT companies earn their money in dollars. So to the extent of the stocks there, they won't face that rupee depreciation's impact. So for that's why FIIs also favor IT companies in such situations. The third aspect is the rate cut. Rate cut is positive for the BFSI sector. Now, as you know, Indian IT companies on an average sell 55 to 60% to America, and within that 55 to 60%, another 60 odd percent is to the BFSI space. So if the BFSI space is going to rally in the US and the outlook is good, then they will also start investing on the tech backend in the AI, which is where AI consulting, I believe, is the next wave of growth for IT. And the companies that actually go and do that through acquisitions or somewhat is the ones which are going to be the winners. And the banking sector space there is obviously going to face challenges of AI. They will need consulting, advice on that, and that could be an opportunity. So overall, like I said, I continue to retain my positive outlook on the IT space, and I think that market is starting to show that recovery, and I think that it will sustain for some time.
Okay, that's about IT, but there are a couple of other themes, emerging themes, so to say. I want to draw your attention to the data center story as well. A couple of days ago, was just going through a report from Jefferies where they are expecting capacity to grow 5x by 2030 in the next 5 years or so. How does one position themselves for this boom, so to say? Should one play through the infrastructure power kind of plays, or should one look at the telecom end of the spectrum? How should one play it? And of course, there are other newer themes mushrooming around this data center, which is like data center cooling solutions, etc. Should one position themselves in that end as well? How would you look at this
See,
entire thing?
so I think that's a lot of news is in the price, but at the same time, the growth could surprise. So
Okay.
what I would say is that you mentioned, should I do this? Should I do that? I should say, do all of it. Buy everything, diversify it across, because don't go and try to pick the winners, okay? But pick the sector.
Hmm.
That sector and its manifold manifestations, and which are all the ones real estate will benefit from it, right? Because of the need for huge
Hmm.
places.
Yeah.
So I think that overall, you mentioned telecom, mentioned power, you mentioned infrastructure, the whole gamut. So have a portfolio which is designed to benefit, because today pure clarity of a data center play is very highly richly valued and priced well. So you cannot expect that kind of growth, but we have to wait for the numbers to happen. But my thing is that definitely this is a big growth space. I'm no doubt about it. So diversify is my saying. Don't leave anything to chance. Buy everything and keep it in your
Hmm.
portfolio. And this is diversification will help. So that's the way I approach any of these new age technology where, if you go back to the classic days of Zomato versus Swiggy, just go and buy both. No, why are you trying to pick whether Zomato will win or Swiggy will win? Why are you going trying to pick the winner,
Hmm.
right? Okay, you'll make half the profits, right? But you'll make half those profits. You're not that you picked the wrong horse and made losses, no? So I'm saying that that's the way any new emerging space which looks hot and happening, I would say buy everything. That's the best way
Hmm.
for a
Sure.
normal investor, because we don't have the benefit of really knowing underlying the deals, what's happening, what's that. There's a lot of question
Hmm.
marks around that, but there's a good story there. So buy the
Hmm.
story, buy pretty much everything that's available there in reasonable proportion, diversify across the place,
Hmm.
and be present there.
All right, that's about the data center theme. But one theme that has been picking up space or speed, so to say, once again, is the railway stocks. Right? Do you think Street is looking beyond the execution risks that companies also flagged off, and of course that has been one of the concerns. And Off late, railways companies have been bagging a lot of orders. So the focus has moved there once again. So is the up move that we've seen in railway stocks off late, is it durable? Could it extend, or do you think it's just a one-time thing that it's moving on the back of order wins?
See, I'm a bit nervous about railways, to be honest. And like you said, for me, those execution risks are very key, important. Yes, there's a story of India's tier two, tier three cities also going down the metro way, right? So that's a huge amount of thing where a lot of manufacturing can take place in the various space. So order books will be good and good, but execution still remains, and especially since of the PSU element where there is always inefficiencies at play, right? So to me, it's a standalone. I would say I hesitate to take that risk because I think the valuations are quite rich. So yes, over a
Hmm.
5, 10, 15 period, it may pay off. But if you have the patience, rather, I believe that as part of an overall infra pack, if railways forms a part of it, that's the best way to play it. Don't put all your eggs onto the railways part, because I think those execution risks and the inefficiencies of the PSUs are two big drags on those, which the market, in my opinion, is not fully pricing those negative risks. They're only pricing the good news.
Hmm. Okay, that's about railways. But what about logistics? I've been reading quite a few bullish reports on logistics, and of course, as consumption rises, logistics is another sector that stands to benefit. Anything that catches your attention within the logistics space? Would you look at newer age companies like delivery, or the oil and gas logistics companies like Aegis, etc. would catch your fancy?
No, actually speaking that, see this new age logistics and related to consumption, all of that is just a near-term festival season thing, right? To me, the logistics play comes
Hmm.
from a much deeper story, which is the story of the festival season being a blowout season on the top line. Bottom line, I'm not yet
Hmm.
sure because I think that companies will need to massive offer heavy discounts to push through those products. So margins will wait and see. But anyway, that's the second story on consumption. But the top line growth, I think there's not much doubt about it. And what that's going to lead to, I believe, is an increase in capacity utilization in the country. And I think the private capex cycle is now very close to really picking up steam. In the next 9 months to 12 months, I think it will pick up. Already in the power and green energy and a lot of those, already the green shoots are there. But on a broader manufacturing expansion cycle from the private sector, logistics is a huge part
Hmm.
because not just cement and steel, but all the machinery which gets to be manufactured is made in the clusters which are there in different parts of the country are specialists for like Coimbatore for textile machinery. Like you have clusters there, and from there they have to transport it to the ultimate. So overall logistics, I think, has a huge potential from a private sector capex brought out. So I think that to me, that's the story really to play. Because just talking about shifting of consumer durables is a Diwali Christmas event, right? And maybe in Chennai it's a Pongal event.
Hmm.
But after that, what, right? So I would say that don't play the near term pop up in demand, but play the longer term story, which is a more structural story of a private capex revival. To me, that's the big story which is
Hmm.
going to deliver value creation over the next 3 to 5 years.
All right. One more pocket that's been in focus is the metal pack. Of course, cyclical in nature, but a lot is working in favor of metals, right? Dollar index sub 97 levels. We have the Fed rate cut, of course, that we are anticipating. And another big factor is that involution drive that's underway in China. Metals expected to benefit as a result of that. But even domestically, the steel duty has been extended for 3 years. So the safeguard is also in place when it comes to steel. So how does one play the metal universe now? Should they look at the ferrous end of it, non-ferrous end of it, and how should one look at this entire pocket given its cyclicality as well?
So are you including gold and silver within the metals pack? Tell me that.
No, I'm not. No, no, I'm
Because you
not.
mentioned the Fed
That's a
rate cut,
separate
the
question
dollars would
altogether.
be. That's a great question. Okay. So non-gold, silver metals, right? Now, see, one thing is that I have a slightly contra view on this whole China thing. So I think Chinese economy, the
Hmm.
infrastructure boom days are past. It's now a consumption story that the government is trying to stimulate. Okay, and under the consumption play, China, which is today 50% of the world ferrous, non-ferrous, non-gold, silver part demand, is right. It's I don't think that the past that they are going to be at that 50% because for consumption you don't need that much of steel or iron ore or copper or aluminum or whatever, right? Because it was the past, which was the housing boom plus the Chinese infrastructure boom that led to that. So I'm of the view that there's going to be a softening of the metal demand from a China perspective. Now, domestically, yes, the infra cycle boom will mean it's good for the ferrous metals and for the non-ferrous also, because copper and aluminum are also needed in electrical wiring and all of that, right? So demand side of story is strong and good in domestically also. But prices for metals are set at the London Metal Exchange, not in India. So the local demand supply
Hmm.
does not alter the price of steel. So you are at the whims and fancies. So that's why metals are treated as a pack called global cyclicals. So the global cyclical is the world is in a slowdown space. China is shifting from infra to a consumption story. They are trying massive stimulus. Will not don't know whether it will work or not work. So from a perspective of that, I am very cautious about metals. Right? It's a very tactical play. Sometimes you feel they are oversold. You go and buy a little bit, but as a structure of the story, right? Unless the world comes beyond the tariff scenario and looks at a world growth path, forget about India for the time being, right? Metals are not something which are going to go through a multi-year bull run, according to me. So to that extent, I would say that
Hmm.
you be cautious about it. Domestically, like I said, the government has to put these barriers to protect the industry, right? So you are looking at this as a defense, right? Not as an offensive note. So I would say, as far as your infra
Hmm.
pack, metals will be a play, domestic metals, and definitely ferrous, non-ferrous, both have a building materials component to it, which will benefit all factories which expand need metals there. All machinery industrials need metals. So I don't see a problem at all on the domestic demand side. But from a steel or this company's perspective, his profit margins are a function of price into quantity. Quantities will be good. What will be the
Hmm.
price? God only knows. We don't know how the internal scenario is going to pan out. So I would say that it's hard to take a buy and hold call. It's a tactical call, and you're probably better off relying on technical experts rather than fundamentals in terms of when you enter and when you exit.
Hmm. All right, got your point. Always interesting chatting with you, Sunil. Lots of perspective, point of view taken, and of course, a lot more questions as well. But of course, we'll save it for another day. Always a pleasure, Sunil. Look forward to again interacting sometime soon. Lots to really watch out for in terms of the India-US talks, how they go ahead from here, and of course, once FIIs come back, I'm definitely calling you on the show again. Thank you.
Sure. Absolutely. Thank you.
Thanks a lot. On that note, take a look at the market. We have picked up steam, almost 90-point uptick on the index now, 25,330. That's where the Nifty is at, and the Sensex is also up over 250 points now. Broader end of the markets, although have cooled off slightly, but nevertheless in the positive zone. Well, with that, we've come to the end of this edition of Opening Bell. Of course, we'll catch you at closing at 3:30 p.m. Don't forget to tune in for that. Till then, of course, stay tuned to moneycontrol.com for all your news and on the latest on the market and on the corporate front as well.